Hi, my name is Ayako Yasuda. I've been a finance professor since 2001 and have been with UC Davis since 2009. I'm an author of a textbook on venture capital and technology finance, and I'm also an expert and advocate of impact investing and responsible investment. I will center my talk today around 3 questions on impact investing that I have thought and have done research about. 1, are impact investors willing to accept lower returns? 2, why do impact investing instead of maximizing return and then donate a portion of the profit? And 3, if we decide to do impact investing, how do investors agree on which impact to prioritize? So that we are on the same page, I'm focusing on impact investing in private equity asset class, which is the second largest category after private debt. Here's an example. Impact fund called South Asia Clean Energy Fund raised its fund by raising capital from various investors. They're called limited partners. For example, IFC is one such LP, which then provides capital to South Asian Clean Energy Fund. And then in turn, the fund invests in for-profit companies. For example, these 2 Indian companies, Prince Pipes, which makes water pipes, and ESDS, which builds data centers. Water pipes used in irrigation and rainwater harvesting, these lead to water conservation. And ESDS build data centers that consume substantially less energy. If these companies are successful, the financial return will flow back to the fund, which then flows back to IFC. In addition, there is this environmental return or the externality which they generate in the form of water and energy conservation. So to me, this externality mandate distinguishes impact investing from a single bottom line, materiality-driven sustainable investment, where the investors are paying attention to ESG factors as long as those ESG factors are potentially affecting your bottom line. In a paper titled Impact Investing that came out in the Journal of Financial Economics early this year, my co-authors and I asked the first question: are impact investors willing to accept lower returns? And we find the answer is yes. Our finding pushes back on the assumption that proponents of impact investing often have, which is that investors are unwilling to sacrifice financial returns, and therefore we must market doing well by doing good as the rationale. Our research design is based on this random utility willingness to pay models that are used often in consumer choice models. Observed choices of investors or the LPs reveal their utility, non-pecuniary utility, from investing in impact funds, as opposed to traditional VC funds that look otherwise similar. We find that investors accept 2 to 3% lower expected IRR or willingness to pay for impact. And this willingness to pay really varies. Development organizations, foundations, banks and insurance, public pensions, geographically Europeans more than Americans, and UNPRI signatories all have high willingness to pay. Mission-based organizations or organizations facing political pressure to invest in impact also have high willingness to pay. In contrast, investors subject to legal restrictions against dual bottom line investing do have low WTP or the willingness to pay. So this variation in the willingness to pay has rich implications. Just to name 2 here. Impact categories that have more high public good or externality component have high willingness to pay. For example, for environmental funds, this translates to about 3.4 to 4.7% excess IRR. In contrast, laws of fiduciary duty against dual bottom line investing, such as the ERISA that governs pension funds in the US, sharply reduced investors' willingness to pay. And since about 1/3 of all investors in our sample are subject to this type of restrictions, we believe that even subtle shifts in the interpretations of fiduciary duty could result in potentially large increases in the investors' willingness to pay. In a study by Bauer, Rolfe, and Smith, they find that Dutch retirees say they support allocation to impact even with lower financial expected returns. So this suggests that when the investors value externality, investing in impact may indeed be compatible with fiduciary duty. The second question, which I think demands our attention, is when we want to invest in dual objective impact versus implementing a more traditional strategy of separately first invest to maximize return and then donate part of the profit. This is a relevant question for individuals as well as for mission-driven organizations like foundations. So here's a framework. As an entity that values both financial return and externality, you have two alternatives. One is to invest, say, $1 million in a traditional VC fund, which say then earns 13% or $130,000. You decide to take 30,000 of that 130,000, donate it to a charity or nonprofit, which then generates impact. Alternatively, you invest $1 million in an impact fund, which then returns to you 100,000 or 10%. So that difference of 30,000 is effectively what you're paying for impact. And then impact funds instead invest in for-profit portfolio companies that then generates the impact. So with this framework, we can then ask, when does it matter which choices we are making? When does this impact investing generate greater impact for dollars spent? I'm fascinated by this question, and there's very limited systematic evidence to date. Anecdotally, I list 4 potential differentiators of impact investing here. For example, innovation with IP protection, scalability of business, recurring versus one-time impact generation, and direct influence through board channel, as opposed to a more indirect channel that nonprofits might play as a consultants for businesses. The last question that I find important is, through which mechanism do investors agree on which impact to prioritize? In theoretical models, this problem is often abstracted away by defining a very simple variable like clean or green. But with public companies, it's hard to implement a proxy vote to pressure firms to choose clean technology, because with diffuse ownership and high turnover of investors, there's little guarantee that investors of a public company can agree on which impact to prioritize. Fama, in a recent paper, articulates this critique. Here I quote, "Unlike wealth, welfare has multiple dimensions and tastes vary across shareholders. How do we enforce a contract where managers are evaluated on multiple dimensions of welfare with randomness in each? This puts us in a quagmire of satisfying the divergent tastes of shareholders." I posit that while the problem is real here, it is more solvable with private equity, with private ownership and a PE fund structure. The number of LP is small and fixed, and for a given fund, and once the fund is raised, everyone's locked in 10 years plus. Some study by Gacy et al. That study impact fund contracts find that at the portfolio company level, fund managers can veto change in a business plan when that conflicts with generation of impact. So these features make PE potentially better equipped to handle this issue of impact target setting and tracking. So in conclusion, the literature has shown that impact investors are willing to pay for externality because they value this non-pecuniary pecuniary utility they get from investing in impact. When would the utility from investing in impact exceed the utility from maximizing returns first and then donating? Here we are in need of much more systematic and sector-specific evidence. And I'd love to collaborate with anyone who can provide high-quality data. And I posit four hypotheses here: scale, innovation, recurring, and board seat. Private equity fund structure and governance mechanism might allow PE fund managers to fundraise from a group of LPs with similar preference for impact, and thus avoiding the high contract costs associated with stakeholder capitalism. I hope you enjoyed this overview, and I look forward to hearing your questions and comments.